Stocks closing slightly lower today, mostly unchanged. Ending the month, though, firmly in the green. 7th straight positive month. Our next guest expects the rally to continue, assuming the pandemic does not cause another shutdown. Joining us now for an exclusive interview, value investor Scott Black of Delphi Management. He's got some stock picks for us as well, Scott. Before we get to that, I always like to get your take, though, on the environment for value stocks, since you are a value stock picker a long time. And we've had this real tug of war between growth and value this year. It doesn't quite feel like we know which kind of environment we're in. This month, the NASDAQ won, up 4% on the month, but value's been doing better than it has in years. So where does that leave us?
Well, truthfully, over the last 3 months, value has been trumped heavily by the large cap growth of the NASDAQ. The Russell 1000 growth is up 14.2%, and the Russell 2000 is up 0.1%. So you've been left in the dust. Valuations are very close at this point. The S&P 500 is about 22.8 times this year, and yet the Russell 2000 is roughly 20 times, and the Russell 2500 is 20 times. So there's not a lot to choose from in terms of relative valuation. But the money has definitely gone back into the large cap stocks. As you probably know, the top 5 stocks in the S&P, about 21% the market cap, and in the NASDAQ, the top 5 being Apple, Amazon, Google, Facebook, et cetera, those are about 42% weighting. So the indices are driven by the large cap names at this point. I think what happened is when there was the onslaught coming of the Delta variant, people got worried that the economy was going to fizzle out. And unfortunately, I think the money's rotated back into the big cap names with sustainable earning power.
But to your point, valuations are high across the board. So where are you finding it these days?
Well, you have to do item selection. As you always know, we look for companies with high returns on equity, strong free cash flow, sustainable earnings at low multiples. So I have a tiny little tech company out in Fremont, California. It's called iCore. It went out today at about $44 a share. The market cap is $1.28 billion. It's got a bulletproof balance sheet, $80 million in cash on the balance sheet, which is $277. The earnings will be up nicely at $370 this year, and then $415. It's a 10 PE. And basically, it's got the wind to its back. If you know about what's called wafer spend up front, that's the thing that drives like AMAT, Lam, KLA. This year's going to be a record at about $80 billion, and next year's another record at $86 billion as people try to go to 3 nano and 5 nano wide line widths. This company makes delivery gas and chemical delivery subcomponents. Their 2 biggest customers happen to be AMAT and Lam. Number 3 is ASML, all of whom are doing extremely well. As you probably know, if you look at KLA, Lam, and AMAT, they're selling at 19 times forward earnings. This is a surrogate play at a 10 PE. The company generates nothing but cash. They've had nothing but free cash over the last 3 years. This year is no exception. In the first 6 months, they generated another $24 million in free cash, and the company does about 22% return on equity with 0 debt. So I think it's an interesting play, and the primary demand is behind them.